Well, good afternoon, everybody, or good morning if you're in the West. And thank you very much for joining us for our webinar today, Investing Mastermind Series. This is the first webinar in this series that we're putting together where we're inviting some special guests to come and share with us their insights. These people are all very successful investors, so we need to take the opportunity to learn from their insights and to take control of our investing destiny. And so today we have my good friend, Roger Montgomery. Now, Roger and I have known each other for literally decades. We've been friends as well as worked together on various projects over the years. One of those was back in 2010 when Roger founded Montgomery Investment Management, and I had a small role sitting beside him at that time. Now, Montgomery, I'm sure most of you know, but it's a boutique Australian investment manager, and they offer exclusive access to a range of managed funds across domestic and global equities, as well as private credit. Roger's had about 3 decades now of experience in the funds management industry, although you couldn't tell just looking at him. But he's also been involved in equity analysis, equity and derivatives trading and strategy, as well as stockbroking. You've probably seen him before on the television or heard him on the radio or indeed read some of his writings in the press, such as the ABC and the Australian. He's a well-known media personality for his investment expertise. So today, as first of all, I have to do this fun part. This is the disclaimer, of course. Please bear in mind that any information that we provide is not financial advice. We do not know your personal circumstances, so anything that we say should be taken as general in nature and not personal. If you need advice, then you should seek that from someone who's licensed to give you that advice. And of course, remember, past performance is not an indicator of future performance. Also, just to let you know, this is an interactive webinar. So down the right-hand side there, you should be able to see people are already putting in some comments. We will have my colleague Elio moderate or responding to comments as he can. So feel free to ask questions and make comments down there. And Roger and I will also try and get to some of those if time permits. So today's webinar is on selecting high quality stocks. Roger is indeed well known for his focus on investing in quality businesses, and it's something that I'm pretty passionate about too. There's been many academic studies that have found a strong correlation between investment returns over the medium to long term and the quality of a business. And when you think about it, investing in quality just kind of makes sense. I mean, the most obvious thing is, well, why would you invest in something that wasn't quality? But when we're talking about investing, quality actually is something that can be defined by financial metrics. And whilst there's no actual consensus as to the exact definition of quality, there's general sort of agreement as to the particular attributes that make up a quality stock. And they tend to be things around the balance sheet strength, the cash generation, the stability of earnings and revenue. Other important aspects include the quality of the franchise and key trends in some of the fundamental data. So I'll just hand over to Roger for a moment to introduce himself and take you through his fun slide.
G'day, Chris. Hi, everyone. Great to be with you. It's a delight to be working with Chris again. He's a dear friend of mine, and as he mentioned, we've worked together on and off over the last 3 decades. It's a privilege to be with you today. I will be talking. I'll talk about anything that you want me to talk about, but I'll be guided by Chris and his questions, and we'll try to stick to topic and we'll try to stick to time. I will be mentioning stocks. I'm going to be mentioning some companies today that I like and companies that I don't like, companies that our various fund managers in the organisation own. So keep that in mind, because if you rush out and buy any of those stocks, you'll probably be helping us more than yourself. Seek personal professional advice before you go out and buy any stocks, and make sure that you realise and understand that what we're talking about today is general information or general advice only. We don't know your financial circumstances and needs, so don't know whether anything that we're talking about today is appropriate for you personally. Thanks, Chris.
Yeah, so the overview of today's presentation, Roger will introduce his business and tell you a bit about that. Then we're going to look at selecting high quality stocks, in specifically thinking like an investor, how to identify high quality businesses. And then, as Roger said, we're going to go through a bunch of examples of high quality stocks and maybe a few that highlight why they're not so high quality. So Roger, just to you.
Yeah, so many people might not realise that we are if you like, a distribution business, distributing the funds, our own funds, and also the funds that are produced or manufactured by other managers. So we have a team from Australian Eagle, Sean, Alan and Dan, and they manage the Montgomery Fund, the Montgomery Private Fund, and also a long-short fund called the Australian Eagle Trust. We have Gary Rollo and Dominic Rose, who all these guys sit here in the office, by the way, and they manage the Montgomery Small Companies Fund, and they've done a phenomenal job of beating the market in that fund, beating the small cap index. And then we have a group out of Boca Raton and Boston. They've got an office in Hong Kong and London as well, called Poland Capital. That team are enormous. They have about 60 or 70 billion US dollars, which is more than 100 billion Australian dollars under management. And in Australia, we distribute their Poland Capital Global Growth Fund and their small and mid-cap fund. And then finally, Brett Craig, who was in our office earlier this morning, he runs the Aura Private Credit business. He's been running that business for 7 years now, and his flagship fund is the Aura High Yield SME Fund, which will soon be renamed to the Aura, I think it's going to be called Private Credit Income Fund, the Aura Private Credit Income Fund, and the Aura Core Income Fund. Now, these aren't equities. These aren't equity funds. They are private credit funds, and they have also done a phenomenal job of generating monthly cash income. They have had no volatility since each fund's inception, zero volatility, no monthly losses, and they've produced, in the case of the Aura High Yield SME Fund, a return over 7 years that's better than the ASX 200. Across all these funds, one thing links them, and that is the focus on what we're going to talk about today, which is quality. So whether it's the Australian Eagle Asset Management team, whether it's the Montgomery Lucent team in the Small Companies Fund, the Poland team, or Brett Craig over at Aura and his team, everyone focuses on high quality. No one's investing in distressed businesses. No one's investing in turnarounds. No one's investing in asset plays or breakup situations. We're all investing in businesses that we believe will be successful as going concerns, and that we believe are going to grow, and that we believe have some competitive advantages of some description. So that, in a nutshell, Chris, is the summary of our business.
Great, thanks, Roger. Now, I should also mention at this point that Roger is the author of a book called Valueable. This is a best-selling book, has sold many thousands of copies. I had the privilege of helping to edit it way back in the early days. Now, I do encourage you, if you haven't already read Roger's book, to get along to that website there, rogermontgomery.com/valueable-book, and have purchase his book. It's well and truly worth it. Also, go along to his website, rogermontgomery.com, and sign up for the insights. They produce regular articles as well as videos and a lot of really great content, which you can avail yourself of and increase your knowledge around the share market.
Chris, just before you move on, a little story about the book. It was self-published, so I published it on my own. And that little dollar coin that you can see there that separates the word value and able, hence the name Valueable, that little dollar coin, I didn't know this at the time because I self-published the book and had the cover design, but I had to get permission from the Reserve Bank of Australia and Government Treasury to be able to put that dollar coin on the cover. So that was a huge amount of work that was unexpected. And there was a lot of work in writing the book. It took a year to write and get it just right, but it took a long time and a lot of work to get that dollar coin on there.
There you go. It's those small things that always catch you out.
Yep.
All right. So let's move into the topic of the day. thinking like an investor. So, Roger, tell us, what are some of the key attributes to think like an investor? What do you mean by that phrase?
Yeah, look, it's really important in everything that you do. It's important to have a framework. So my wife's framework for raising our children was always, she's not raising kids, she's raising adults. And that then informed the decisions that we made about the way we spoke to them and the incentives we gave them and the things that we did. We were raising adults, we weren't raising kids. In investing, the framework, you can use a variety of frameworks. There's no limit to the frameworks, but the framework that I like to use is this idea that I'm not buying stocks that go up and down on a screen. You know, many people approach the stock market the same way they might approach a casino or a roulette wheel, you know, betting on the ups. They bet on the red, they don't bet on the black. So they're betting on up, they don't want to bet on down. And that's akin to gambling. So lots of people do it, and a lot of people do it unwittingly. They're not even realizing that they're speculating, that they're just betting on up and down, because stocks, as you know, they wiggle on a screen and you can bet on them just like you can bet on a cockroach race or a cane toad race in the Northern Territory. And people do that not realizing that the share price is then informing their decision making. So if the share price goes up, it must be a good company. If the share price goes down, it must be a bad company. Now it's the case that that's often true, but it's not always the case, because as we'll talk about in a minute, the market isn't always perfectly efficient. It doesn't get it right. And there's a number of reasons why that's the case. And I learnt that very, very early in my career working at BT Australia under a man named Richard Farley, who became a billionaire in his own right. He's a Mensa genius. He's a world chess master, and he taught me a lot about trends and a lot about speculation versus investing, which we'll talk about more in just a moment. The alternative way to think about the market is that equities are pieces of businesses. And there are professional investors that I know really well. There are other fund managers out there who say, Rog, you're just buying stocks and they go up and you make money for your investors, and that's that. My view is you're approaching the stock market as you might approach an auction room where businesses are being transacted. And your job is to buy into really good businesses, high quality businesses, and we'll talk more about that in a little while, but your job is to buy into these high quality businesses when the auction room is empty. You know, when there's hardly anyone there, no one's really interested in stocks. In fact, back when I met you, Chris, or maybe a little bit before I met you, in 1999, I was working at Merrill Lynch, and I was also seconded by the Australian Stock Exchange to run a share market investing course on a Saturday. And we ran it, I think, every third or fourth Saturday in 1999. And it was down on Bridge Street in Sydney. They've got a big amphitheatre downstairs. And in 1999, the market was really, really hot. And in fact, it was so busy, there were people sitting cross-legged on the floor in front of the stage, as well as the 300 seats or 400 seats being full. There were people on the floor, and there were people sitting in the aisles, the exit aisles. The fire department, on one particular Saturday, I'll never forget, the fire department came in and had to clear the aisles for safety reasons. Now, a year later, in 2000, in March, I was out on a holiday out in Broken Hill at Menindee Lakes, and I remember, didn't have a mobile phone back then. I called in to see what was happening in the market. The market had crashed. It was the tech wreck of March, April 2000. But I continued to when I got back to Sydney, I continued to conduct those Saturday workshops for the Australian Stock Exchange. Here's the thing. In 1999, there were 300 to 400 people in the room when the market was hot. After the market crashed, there were 20 people in the room. So you want to buy stocks when there's only 20 people in the room. You don't want to be buying shares of high quality businesses when the room is packed and everyone's bidding over the top of each other, trying to pay the highest price in order to try and secure some shares because they believe the future is only bright. What you want to do is take advantage of when there's no one in the auction room. Everyone thinks we're going into a recession. Everyone's worried that, this is a hypothetical scenario, but everyone's worried China is now blockaded Taiwan. What's the US going to do next? Is this going to go nuclear? Hey, let's get to cash. The stock market's fallen 50, 60, 70%. I'm out of here. I think the future is going to be a disaster. I want to get out. When most people are thinking like that, that's when you want to open your wallet, walk into the auction room and say, yeah, I'll have some of that, I'll have some of that, and I'll have some of that. I've been eyeing it off for years. So thinking like an investor is thinking of stocks as pieces of businesses and buying them at rational prices. And usually that is when the auction room is empty and no one else wants to buy.
They need a strong stomach, in other words.
Yeah, I think when I was younger, I would have agreed with you. I would have said you need a strong stomach, but now it's habit. So now you just wait. It's just a matter of time. It'll happen. You just have to be patient.
Yeah, absolutely. All right. So I guess what we need to talk now about, how do we actually identify some of these quality businesses? What are some of the key attributes that you're looking for, you're searching for in some would say to you, this is a high quality company?
Well, it's actually one of the factors that you can filter on with the Stockopedia app or platform, Chris, and that's return on equity. I just want to focus on return on equity for a minute, if that's okay with you. So when a lot of people think about businesses, they focus on what's coming out of the business. So they're focused on the profits that are coming out. And we'll talk about profit growth in a minute, because profit growth is really important. And a business that's growing its profits faster than other people expect, that's even better. That's almost a guarantee for making money. But instead of just focusing on what's coming out of the business, the profits and the dividends, we should think about how much money needs to go into the business to get that money out. If I said to you, this business is making $1 million a year, business X is making $1 million a year, your response to that is, I don't have enough information. That's the right response. If I said to you, in order to get that $1 million out, you only need to put $1 of your own money into this business and you will extract $1 million from this business. You would think that's an extraordinary business. If I said to you, you need to put $1 billion in to get 1 million out, you would think that's a rubbish business. And what we're talking about here is return on your equity. So if you think about a company's balance sheet, you've got assets, you've got liabilities, and this is in the simplest sense, and forgive me for making it too simple perhaps, but you've got assets, you've got liabilities, and what a lot of people do is what they were taught in accounting 101 at university: assets minus liabilities equals equity. Well, another way to think about that equity, and it comes to the same number, is to think what the owners put in, and which is the shareholders' equity that's been contributed, and what owners kept in, which is retained earnings. And if you think about the equity as being shareholders' capital plus retained earnings, that's the total equity of the business. So the equity in the business is what's been put in and what's been kept in. And then what we want to do is work out how much did I need to put in and how much did I need to keep in to get the profits out. And the higher the profit compared to what I put in and what I kept in, the higher the return on equity. And that's why a business with a high rate of return on equity is attractive. Now, here's what we're looking for specifically: a high rate of return on equity that is sustainable, that is repeatable. So I'll tell you why that's important. I learned in microeconomics at university that if I start a business and I start generating a really high rate of return on my equity, that high rate of profitability will attract competition. Other businesses will start in my space And what the first thing they will do is the simplest thing, which will be to do the same thing that I do at a lower price. They'll offer it cheaper and they'll undercut me, and then my return on equity will go down. So will theirs. And eventually the return on equity of the industry that I'm in will normalise at some fairly average level, that's not particularly attractive, where there aren't many new entrants coming in. There's kind of an equilibrium return on equity for an industry. For every industry, it's a little bit different. It depends on the cost of setting up in that industry, amongst other things. But then if that's true, and yet there are businesses out there that have been generating 20, 30, 40, 50% return on equity for years, for decades even, well, how is that possible? How is it possible that they can keep getting 20 or 30% if competitors come in, charge a lower price, and compete away that high rate of profitability? The answer is that the business has a competitive advantage. It has something, it does something, or it owns something, or it does something in a certain way that isn't easy to replicate. So it could be its brand, it could be its reputation, it could be that it bought the equipment that does this years and years ago when it was really cheap to buy it, and now it's super expensive and so no one can compete. It could be that it's a company like WD-40 that, it makes a product that is so low margin and it lasts so long. WD-40 lasts 7 years. You've got a tin of WD-40 in the shed. It's got a rusty little ring on the bottom. You bought it back in 1999. You use it once a year. When a hinge squeaks, it keeps working and you never buy another tin again. So no one wants to compete with that. No one wants to set up a business, start making WD-40 and sell one tin that they make 1 cent on, and no one's going to buy it again for 7 years. So WD-40 has this entrenched competitive advantage. But and then you think about Westfield. Westfield has a competitive advantage as well. It's a geographic advantage. No one's going to set up a shopping mall next door to a Westfield. It's a pretty silly thing to do unless you're in Chatswood. They're renovating and putting more capital in now and trying to compete better with Westfield. It's an expensive enterprise. So Westfield is an example of a geographic monopoly. Transurban, with all the toll roads around Australia, they have a geographic monopoly. If you want to get somewhere fast, you've got to pay a toll. They own it. Another business is realestate.com.au or REA Group. That's a classic one, actually, because I mentioned earlier that competitors usually come in and charge a cheaper price. There are lots of competitors of REA who charge nothing. There's actually 82 websites in Australia where you can list your house for sale, and about 80 of them, 79 or 80 of them, charge nothing. They're free. You can list your house on there for free. And yet REA charges the most. It's the most expensive. And despite being the most expensive, it has the most houses for sale on its website. And because it has the most houses for sale, it has the most people looking for houses and apartments to buy. So it has the network effect, even though it's the most expensive. Now, let me summarize it this way. The most valuable competitive advantage, the single most valuable competitive advantage of all, is the ability for a business to charge a higher price without a detrimental impact on its unit sales volume. In other words, it increases the price and people still cross the road to buy the product from that business, even though it costs more. And Tiffany's is another example of that. Tiffany's charges more for its diamonds. By the way, I've never bought, maybe I bought one necklace for my wife or one pair of earrings from Tiffany's, and then I got sensible and decided never to do it again. You can buy the same quality diamonds with the same cut, same clarity, same quality, same. You can buy from Diamond Merchant at probably 1/10 or 1/20th of the price. The exact same diamonds you get at Tiffany's. So why would you pay more? And yet people cross the road. They don't buy their diamonds from a diamond merchant. They cross the road and they pay more from Tiffany's. Why? Because of the blue box, the provenance, the reputation. You don't have breakfast at Michael Hill It's breakfast at Tiffany's. It's not breakfast at Michael Hill. And part of Tiffany's offer is they deliberately charge more because there's a perception that if the diamond is more expensive, it's better quality. They know that when a guy or a girl gets down on one knee and says, "Will you marry me?" they know that they're not going to finish the sentence with, "Will you marry?" They're not going to say, "Will you marry me? Oh, and by the way, I saved 40% on this ring." That just doesn't sound very romantic at all. And so, there are some examples. So going back, what we want is sustainable high rates of return on equity, a business able to demonstrate some sort of competitive advantage. And the most valuable competitive advantage of all, as I said earlier, is the ability to charge a higher price without a detrimental impact on unit sales volume. In other words, volume doesn't go down when price goes up. Volume stays the same or volume goes up. And REA, year after year after year, has raised the price, and it's done it a clever way. It hasn't just jacked up the price. It's offered a platinum, there's a gold service in there. There was a silver service before that, then the platinum service, then the diamond service. They keep adding bells and whistles if you upgrade to the next most expensive package, which everyone does because they want that particular bell or whistle. And so, REA is a business that's been, even though in Australia over the last 15 years, you've seen total number of dwellings for sale in Australia declining every single year, REA has been able to increase its revenue and increase its profits by lifting its prices. So, Chris, in summary, that's a fairly long-winded answer, and I'm sorry if I'm going over time. But when we think about quality businesses, I focus first on return on equity. But then there are some other factors like earnings growth and the earnings surprises and things like that, which we can talk about in a moment if that's where you want us to go.
Yeah, well, why don't we just digress for a moment? There's a question here from Ryan. How do you think about the interplay of ROE or ROIC, growth and margins when assessing quality businesses?
Yeah, so return on invested capital and return on equity and return on assets, they're all measuring the same, a similar thing. They're not identical. One of them takes into account, notice I mentioned return on equity because we always try and find businesses, not always possible, but try and find businesses that, and listen to my words here carefully, that don't need debt. They might have some debt, but they don't need debt. They don't need to borrow money. So you want businesses with little or no debt because they don't need it. If they've got debt, but they don't really need it, they're using it because it's a clever, tax-effective way of raising some money, well, so be it. We don't mind if they have some debt. But when we think about ROE, ROIC, ROA, as long as we are looking at a long-term, sustainable, attractive rate, then that's pretty much the same story. So
what about margins? Like some businesses like a Woolworths will have a very low margin, whereas others have quite a high margin. I think REA has a high margin from memory.
Yeah, but if you focus, I bring it back to ROE because it takes into account everything. It takes into account what's coming out of the business after margins, after costs, and it's also taking into account what you've put in. If you look, for example, at Woolies and Coles and they've got a really low margin, for example, what that does is it distracts you from the fact, or you might miss the fact that their working capital earns them money. They actually buy product from a supplier that they don't pay for 6 months, 3 months or 6 months. They sell that product the next day. And when you go and pay at Woolies or Coles for your groceries, you don't give them an invoice. You don't ask, to pay in 6 months' time. You pay them right there and then. They're not giving you a loan, right? So they're turning over their product multiple times before they even have to pay for the first purchase. And so if you look just at the margin, what they're making on each individual sale, it doesn't look like very much. But because they're turning over that product so many times compared to how often they're paying for it, right, they're making, they're generating cash from their working capital. And you'd miss that if you just focused on margin. However, for other businesses where, the working capital perhaps isn't as extreme in terms of how much cash it's generating, then margin Margin is an important thing to look for, and it might tell you, particularly gross margin, how the gross margin is changing can give you some information about how that business is perhaps performing compared to its peers in the same space. So margin on its own might not tell you anything, but if you compare it, for example, to working capital turnover, or if you compare it, for example, to peers, other players in that exact same space and what their margins are, it might give you a picture of the quality of the business.
Cool. Well, why don't we talk about a few stocks? I mean, we already have, but let's keep going. We've had a question from Srinivasan, apologies if I pronounced your name wrong, about CSL. What are your views on CSL, Roger?
Yeah, look, this is, there are, in my view, there's 9 or 10 businesses in Australia that I would regard as, A1 quality, just the absolute top quality. And I know you know what they are, Chris. CSL, I think, is one of those businesses. I think that this is a business that has, quite substantial competitive advantages. That is in terms of its patents on its products. In hematology, immunology, there's CSL Behring, of course, which everybody knows, and that's the vaccine business essentially. Then you've got Vifor, which is your kidney business, if you like, and then within those businesses they've got amazing patents and they've got amazing footprints of blood collection centres. They are going to continue making money as they increase that footprint. They will continue making money as they increase the prices of the products that they sell. They're non-cyclical, which we like. They actually produce a lot of their vaccines. They produce a lot of their vaccines that are needed. They're produced during the Northern Hemisphere summer, which is the Southern Hemisphere's winter, but they're demanded. Obviously, a lot of the products are sold in the Northern Hemisphere winter. So you don't get cyclicality or economic cyclicality, which we think is a good thing. But most importantly, we think that this is a business that through increasing its blood collection footprint, as well as increasing prices over time, they will maintain and grow their margins. We think that they'll probably grow their profits at somewhere in the mid-teens, it could be 15% even, over the next 5 years. And based on an average PE ratio of the last 10 years, then, their shares could be in 5 years' time, their shares could be $500. So, it's a business that ticks a lot of boxes in terms of low debt, high return on equity, therefore high quality, or maintaining a very attractive rate of return on equity. And then, of course, that's protected by patents and footprint.
Very good. So keeping on that theme of healthcare, we've had a question about Cochlear. Would you like to expand on your views on Cochlear?
Yeah, well, this is another business that ticks a lot of boxes in terms of sustainable competitive advantages. And let me summarize this business really, really quickly. They have less than 5% penetration in the market that they're selling to. The idea that they are mature is an absurdity. The long runway for growth that they have stems from the fact that their solutions for hearing impairment have really only touched the surface in terms of the number of people that qualify as patients for this particular products that they offer. They've got long-term global growth. Cyclicality is negligible, if not non-existent. They've got a great reputation, a fantastic reputation. You look at what's happening to their competitors at the moment. They're in a net cash position. We talked earlier about having no debt. They've got a net cash position and they generate very, very strong cash flows. This is a business that we own. So is CSL, by the way. We own it in both the Montgomery Private Fund and the Montgomery Fund. Okay,
very good.
Oh, and I should add that that They'll also, they've got a huge installed base already, even though they're just scratching the surface in terms of tangible addressable market or total addressable market. But they'll be able to continue to service existing customers. One of the things that I'm really torn about, actually, Chris, is how the world's going to be very different in 5 years' time or 10 years' time with AI, robots, and autonomy, autonomous vehicles. Gosh, China has just approved autonomous flying taxis. The world is going to be a very, very different place in 5 or 10 years' time. And we all think it's going to be great. Well, it might not be if everything we own is on a subscription. And so I do worry about everything being supplied by subscription. In the future, your car will be a subscription. And if you want it to turn on, you better make sure you paid last month's subscription. So, there'll be all those sorts of, and I don't know that necessarily makes us richer. That could make us poorer. Nevertheless, businesses, we love businesses that have recurring income as a high proportion of their sales. So as Cochlear expands out the services that it offers its installed base of users or patients, a growing proportion of its revenue will come from this recurring subscription offer.
Okay.
If my answers are going too long, Chris, you let me know, and I'll tighten them up for you and for everyone else. Pardon me.
Yeah, no, I think we're tracking all right for now. So let's digress a bit away from the healthcare sector and look at a couple of more consumer-focused businesses. How about we have a look at ARB?
Yeah, look, another one of those top 10 businesses in Australia, run by Roger Brown for decades. This is a business that I started following, I reckon when 1990s maybe, or early 2000s. I mean, this is a business, early 1990s. This is a business that has, if you look at the chart, can you get a chart up actually of its return on equity over time, Chris? Is that possible? Can we have a look at that? That would be, you can do that, or you can see it there. There it is. Yeah, there it is. The screen there is. But it's in a trade of return. It's come down. A couple of reasons for that is that slowed post-COVID. So business, by way of background, this is a bit that, for intents and purposes, has been selling for a long time aftermarket four-wheel drive parts and accessories. Now, both Chris and I love four-wheel driving. We love going bush. So we're both probably familiar with ARB's products. I'm an ARB man. I have an ARB lithium battery in my four-wheel drive. I have a dual battery system set up. I also have spotlights and work lights and racks that have all been supplied by ARB. And they're high-quality products. In fact, globally, they're such high quality. They're made in Thailand. A lot of the products are made in Thailand, but they're such high quality that in other countries, they're copied and fake ARB stickers are stuck on the copies. But nobody wants the copies because they're not safe. So people tend not to buy them. And if they can get the product very, very cheap, they know it's not a genuine ARB product, but they want everyone to think it's an ARB product, so they put an ARB sticker on it. So they've clearly got a great reputation. There was a period where the stock was really in the doldrums. This is many, many years ago. And it was because analysts were worried that the products were being copied and that would ruin the brand's franchise. That would ruin the brand's reputation and sales would plummet. But in fact, the opposite happened. And people found, they found that when they hit something with a fake ARB bull bar, guess what? It didn't protect them and it didn't protect the vehicle. And so, more and more particularly, and it's not just people like Chris and I who are buying ARB products. There's a lot of mining companies that are kitting out, their fleets of work vehicles with ARB products. Now, the opportunity for ARB is not in selling the products to Chris and me, which it is doing in the United States now. So it's expanding overseas. The problem with the business in the past, even though it's been an incredibly strong business, one of the problems has been that in the analyst community, it's been seen as pro-cyclical. When times are good, People spend money on blinging up their four-wheel drives, and when times are tough, they stop doing that. We saw that in COVID as well. During COVID, people couldn't travel overseas, so they fitted out their four-wheel drives, and that brought forward, by the way, just as an aside, that brought forward a lot of ARB's sales. So sales that might have occurred over the next 2 or 3 years normally were all compressed into a very short period during lockdown or partial lockdowns, when people could only travel within their state or in their local government areas. But really, the growth is going to be expanding offshore, but more importantly, the OEM deals that the company has now done with Ford and Toyota. OEM stands for Original Equipment Manufacturer, and OEMs like Toyota and Ford initially did deals with ARB where you would decide that you're going to buy a Ford Ranger, you'd turn up at the dealership, and then they would ask you to option it up. And you would option up, you'd say, I want the bull bar, I want the side steps, I want the ladder, I want the racks, I want all these things. And you would tick boxes, and they would be supplied by Ford or by Toyota. And when the car is delivered to you, those pieces of equipment would be attached. They were ARB. The new deals that the company is now has signed, or the new version of those deals, is they're actually manufacturing these products for Toyota and for Ford. And they are Ford and Toyota branded products made by ARB. And you think about, you think that in Australia we sell about 1 million vehicles a year, a million new vehicles a year. About 300,000 of those are replacement vehicles, so replacing traded in or sold vehicles. It's the other way around. 700,000 of those are replaced, and about 300,000 are brand new, being added to the fleet each year. So we get about about the overall fleet of cars in Australia grows at about 2% a year. Anyway, so why do I say that? Ford in the United States sells 1 million of one type of vehicle, which is the Ford F-150. So they sell 1 million utes alone. That is a very promising market for ARB. And so I think what's going to happen over time is that the analyst community will stop seeing this as a cyclical, economically exposed Australian business, and will start to see the optionality of that overseas growth as beginning to dominate the narrative, and that will change the valuation regime of this particular company. And I should say at the outset, this is owned in all of our Australian funds. So this is owned in the large cap Montgomery fund, the large cap Montgomery private fund, and the small cap fund.
Very good. I remember way back in the 80s, my dad bought an ARB bull bar for our bright yellow Land Cruiser. And I've looked back and thought, if only he had put the same amount of money into some ARB shares, we'd have been a very wealthy family.
Exactly. Yeah. And
if
you look at that, let's just have a look at something. Sorry, Chris, while we're there, let's have a look. Can we see, can we just look at where's the EPS normalized? Yeah, EPS normalized. So you can see that since 2018 out to 2024, that's doubling, right? That's almost an exact doubling right there. So we've had earnings double on a per share basis over 1, 2, 3, 4, about 6 years. Now, if we then, can we see balance sheet equity? Can we see the equity?
Yep, book value or book value per share.
Yeah, okay. So you can see that we've also seen book value double. If book value is in fact the equity of the business, yeah. So we've seen that double as well. In other words, the company has roughly, speaking in round numbers, the company has roughly maintained its return on equity as it's increased the amount of money that investors have either put in it or left in it. That's what you want to see. If I owned a bank account and I put more money in the bank account, I want to see that it's not reducing the interest that I earn on that bank account, right? I mean, an ideal scenario is that the earnings doubled and I didn't put any more money into the business. But we know this business is expanding its manufacturing capacity because it's now going to be working with Toyota and Ford. So there's been some big investment that's going into this business. And so consequently, it's grown its equity. It's retained some of its profits. It probably hasn't raised much fresh capital. Probably did actually through a dividend at some point, a special dividend or a dividend reinvestment plan. But what's good to see is that on average, it's maintained its return on equity as it's doubled its equity.
Very good. Yep. Right. I'm going to throw one to you, Roger, without notice. One of the participants here, Maria, has asked about PME. Don't know if this is a business you follow or not.
Let's pull it up.
I'll just pull it up.
Yeah,
the first thing we noticed, very high quality.
Extremely high quality business. Our team, Poland, I mentioned earlier, Poland, who are based in Boca Raton, Boston, New York, London, and Hong Kong. They've got the global universe to invest in. They focus on, Buffett-style, high-quality businesses, just as we do. They own Pro Medicus. It's in their fund. They've only got 30-odd stocks, not even 30 stocks in that fund, and Pro Medicus is one of them. So on a global level, this is an extremely high-quality business. And the only thing that stops people, I think, for a lot of people from buying it is its PE ratio and how expensive it is. But it continues to grow at a phenomenal rate, and we don't see that slowing down anytime soon. In fact, we're expecting earnings over the next 5 years to grow again in the mid-teens, at least.
Very good. I mean, the valuation is always the thing that I find challenging with that stock.
The valuation was challenging a year ago. It was challenging 2 years ago, and the share price is a lot higher than that.
Well, exactly. Yep. All right. So let's just digress back to the consumer sector. There's been a question about Scali. Now, we know that they're making a push at the moment into the UK market.
Yes.
What are your thoughts on Scali?
So this is a business that we own in the Small Companies Fund. We think it's a very high quality business. That's why we own it. A little story about Anthony Scali, who is Nicholas Scali's son, who now runs the business as the CEO. He invented just in time, not even just in time, you have to wait. So in the old days, when my mother bought some furniture, we walked into a furniture shop, we looked at a couch, we saw it, we liked it, took it home. Now, anyone listening today knows that when you walk into a furniture shop, you pay down your deposit and you come back and you'll get your couch in 12 weeks, maybe even 14 weeks, maybe even 6 months for some things. I know that when we were renovating, there was some stuff that we had to order for one of the rooms, and it was going to be an 8-month wait to get this particular product, not because of supply constraints and COVID, just because they had to go and make it. They wouldn't make it until it was ordered and paid for. And so in Australia, Anthony Scali introduced that idea to Australia. And think about what that does. It means that they don't need warehouses to store anything. It means that they get cash on deposit, which they earn interest on. For free, essentially, because someone's decided they've gone and, they want to buy that couch and they're happy to wait for it. So because of that, the business generates really attractive rates on return on equity. We also know that one of the easiest ways to make money in the Australian stock market is to get in relatively early on a great store rollout story. And this is a business that has, because you mentioned the UK just a moment ago, but even within Australia still, there's still plenty more stores that they're going to be able to open. In Australia, this business is underpinned by migration growth, because migration growth leads to household formation. Household formation leads to dwelling purchases. Dwelling purchases leads to furniture purchases. So this is a business, we know 500,000 people came in last year, and we're not going to have as many in the next year, but coming in, but we will still have, a couple of 100,000 people coming in, and that will lead to continued demand for furniture and people upgrading existing old furniture as well. And so it's underpinned by great demographics, by great economic or macroeconomic factors like immigration, high return on equity, little or no debt relative to the cash flow of the business, great store rollout story, and great management.
Very good. All right, I'm just going to digress for a moment here. If I can figure out the right buttons to click. What I wanted to do is just show you some information that I came across when looking through a research paper that was in Stockopedia. Stockopedia has tons and tons of education and research material, and this particular paper, and by paper I'm talking about a 170-page document, was put together by our CEO Edward Croft, looking at the different factors that Stockopedia focuses on, and this particular one is on quality, as we're talking about quality today. This is the UK stock market, so I know it's not exactly relevant to Australia, but it's, you know, similar in principle. What he's done here is he's looked at over a 10-year period, annually rebalanced portfolio, looking at their quality scores, and just measured how have those businesses gone over that period of time. And as you can see there's just a very clear trend. Stocks with a low quality return negative returns. You get into a positive returns around that sort of 40 to 50 quality rank. And then by the time you get up to the top quality ranks of 80 to 100, you're getting returns that in terms of the UK market, we're about 3 times that of the index. So just a very clear illustration there of why Roger and I really like this strategy of focusing on quality stocks, simply because it works, and particularly over the long term. It's a really good strategy to employ. Now, we mentioned at the start of the webinar about Roger's book, Valueable, and as I said, I encourage you to get along to his website and purchase a copy of that. Now, if you're a person who's yet to join Stockopedia, now would be a great time to consider doing that, because of course it is coming up towards the end of financial year, and like many businesses, we do have a special offer in place, and our special offer includes a complimentary copy of Roger's book. Roger's generously made that available to us, and we're going to provide that to you if you sign up for a Stockopedia subscription within the next 10 days. So do avail yourself of that opportunity. All right, so we've probably got time for a few more questions, so I might just jump back into throwing a few of those. I see we've got some coming through in the chat. There's also been a few that have been pre-submitted. If you would like to ask a question, now's a good time to put them into the chat. Roger, there's a question here from John. What markers do you focus on in an emerging company that would signal it as a quality stock?
Yeah, look, it's, one of the things that I didn't talk about is that it's really easy to find quality businesses that have a demonstrated track record. The real work for those businesses is thinking about the future, and when you're looking at emerging companies, so there's a business that listed today, GYG. It's listed at $30. The shares were issued to, there was no shares available for retail investors at all, but the shares were offered to a few institutions at $22, and they now listed at $30. It's been around for a few years. You can see that the executive team has had a great track record at opening stores. So even though it's only listed today, so it's a new business on the stock market, it's not a new business. So if John's talking about those sorts of businesses, well, there is a track record to look at. But if John's talking about a business that doesn't have a track record and has listed on the stock market, so it really is an early stage business, well, you do have to think very carefully about a few things. Let me explain what those things are. You've got to ask yourself, why do I think this business is going to dominate the competitive landscape in 5 or 10 years' time? Why is it that this business is going to be the leader, the winner in 5 or 10 years' time? So if we step back from that question, the question is, why do I think this company is going to be able to grow its earnings a lot? And then you start thinking, well, how is it going to be able to do that if competitors turn up and competitors start competing? How is it going to be able to grow its profits? Well, that opens a Pandora's box of questions. Who are those competitors? What other products might be alternatives to the product that this company is selling or the service that this company is selling? And they're the sorts of things you need to think about, because the easiest way to make, well, not the easiest way, but one way to make money in the stock market is to think about businesses that are going to win, that you're sure they're going to win. And generally in new technology, that's really hard to answer, because you just don't know what technology is going to be the dominant technology. Think about, we were talking about ARB earlier. Think about cars, motor vehicles. Do you know, if you'd been, where was it? I think it was in Stuttgart. I'm not sure, but it was definitely Germany in the late 1800s, 1878 or 1888 or one of those, around then. If you'd been in Germany when Carl Benz drove around in his first horseless carriage, and he did that to promenade around a park. He literally built a car so he could show off to his friends and neighbours around a park. His wife, Betty, or Berta, she stole the car and drove it to another town, ran out of alcohol, ran out of fuel, bought some alcohol from a pharmacist and continued on, bought some groceries and came back. She really invented modern transport. She invented it, not Carl, her husband. He invented something to just parade around the park in. She turned it into something that was viable. Anyway, had you been there, you might have thought this is going to change the world. And a lot of people would have disagreed with you. Henry Ford's lawyer said to Henry Ford, "We don't need automobiles, we need faster horses," quote unquote. So there were people who disputed whether or not cars were going to change the world. But let's say you agreed that they were. Let's say you could see that they were going to change the world. Well, since that day that Carl Benz invented that first horseless carriage, in the United States, there has been almost 2,000 car manufacturers. Not one exists today, perhaps with the exception of Tesla, that is both profitable and hasn't been bailed out by the government or private equity. Not Ford, not General Motors, none of those companies. So, and all the others are gone. All the others went broke, or were taken over, but they're gone. And so, the television is the same. Gosh, you would have seen airlines, commercial transport has transformed the world. We can visit friends all over the world now. We can go to places that we could never dreamed of travel to. We can now travel to Melbourne from Sydney for less than it costs to ride a bicycle there. It's insane. It's transformative. But no one's made any money out of airlines over a long period of time. If you look at the official data collectively over the last decade, airlines have lost money in aggregate. So, new technology is really, really hard to pick winners in. It's even hard to pick the winning technology. So hopefully, look, that's a long-winded answer to the question. But when I think about emerging companies, I usually think it's pretty hard to answer how and why they're going to win.
Yeah.
If you get it right, you'll make a lot of money, by the way. You'll do really, really well.
That's right. Just to digress for a moment, within Stockopedia, Roger mentioned, we have a really good screening facility. And one of the things we have is the ability to screen, well, we have pre-made screens. And so I'm just got on the screen there a list of our quality investing screens. These are screens that have been put together by the team, but based on the philosophy of different well-known investors, and with a focus obviously on quality, but there are other ones as well. Now, Roger, very quickly, we just got time, I think, for one more stock.
I should say, Chris, I can see you've got Warren Buffett Hagstrom screen there. Robert Hagstrom's first book, The Warren Buffett Way, I think it was called, The Warren Buffett Way, he actually got some stuff really wrong about the way Warren Buffett thought about return on equity and earnings growth. And I corrected that in my book. So I'd love to see you guys put up a Warren Buffett Montgomery screen as well. Anyway, just a thought, just an idea.
Yeah, we can take a look at that.
Yeah.
All right. So I better just get back to this. Hang on.
You had one more question. Do we have time, Chris?
Well, let me just run through a couple of points, and then if we have time, I was going to say to you, do you want to talk about either JB Hi-Fi or Lovisa? But first of all, just give us this overview of your business.
Yeah, so if anyone's interested in any of our funds, and it doesn't have to be an equity fund, it could be a private credit fund. Private credit's becoming incredibly attractive at the moment because it's offering monthly cash income, in some cases at very attractive rates. And in the case of one of our funds, which is the Aura High Yield SME Fund, it's been running for 7 years. It's never had a negative month, zero volatility, and it's earning about 9.6% per annum on a compounded basis. So it could be one of our equity funds, but it might also be our private credit funds. If you're interested in any of those things, give David Buckland or Toby Roberts a call on the number there, or send them an email, and they'll talk you through what we've got on offer. And we'd love to be working for you through one of our funds. Thanks, Chris.
Excellent. And I just wanted to mention, as mentioned at the start, this webinar is the first in a series of webinars that we're putting together. The next one we've got coming up on the 23rd of July will be with Alan Hull. I encourage you to come along to that. And then we have a number of others with Tony Canaston and Ron Shamgar, and more people to be invited at later dates. So I know we've reached an hour now. So if you do have to go, we respect that. And thank you very much for joining in and listening. I don't know, Roger, do you have a couple more minutes just to run through one or two stocks?
Happy to hang around for those people that also want to hang around.
Okay, well, what do you reckon? Do you want to talk about Lovisa or JB Hi-Fi?
Well, we can talk about both. It's no big deal. Look, I'll summarise again. Because I realise we're over time, but Lovisa, with respect to Lovisa, what we like about this business is it doesn't cost very much to open a new store. They're opening a lot of stores. I said earlier that one of the great ways of making money, and one of the easy ways to make money in the stock market, is to buy into a successful store rollout concept early in that store rollout story. And Lovisa is early still in its store rollout story. The other thing that I like is, with all this talk about belt tightening and cost of living, Lovisa's main customer is Generation Z. The oldest Generation Z is 27, the youngest is 12. They tend to live at home at the moment because they can't afford to rent and they can't afford to buy in most cases. Because they're living at home, but meant the vanguard of this generation have left university and now working. So they've got a lot of disposable income. They don't have a mortgage. They don't have kids. They're not worried about interest rates going up. They're not worried about interest rates being high. And this is an affordable product. So they can spend money dressing up their outfits with jewelry, and they're doing that. And this company is in the sweet spot at the moment in terms of economic dynamics, in terms of demographic dynamics, and also they've got a successful team rolling out a lot of stores at a very, very cheap price, which produces a high rate of return on capital for each of those stores.
Okay, great. And your thoughts on JB Hi-Fi?
Yeah, look, JB Hi-Fi surprised, in its results recently, its most recent results, it surprised everyone in the market because, and that's why you can see the share prices jump there, and that's because the Australian business wasn't going as badly as everybody thought. That's the only reason it's done well. The share prices bumped up because people thought their Australian business was suffering because of this cost of living crisis, but in actual fact, the Australian business held up reasonably well, or better than expected. It didn't grow, by the way, it just didn't do as badly as the market expected. It's a more mature business. It's got a cyclical element to it, but they are a really important part of the retail economy in Australia. They've got a really high quality number of, their statistics are really good. Their earnings growth, I think some of those earnings growth numbers that you've got there might be a little bit pessimistic, Chris, for 25. I think they might surprise and do a little bit better than that, which is probably explaining why the share price is running up. But return on capital employed, return on assets, attractive. It's just a mature business with some cyclical elements to it that you have to be mindful of.
Yeah, and we should just point out that these earnings numbers are actually market consensus numbers. We're pulling in the market consensus. So Yeah, and the market's not always right.
No, and that brings back to that point that I alluded to right at the start of the session. If you can find businesses that beat analyst expectations consistently, you're almost guaranteed to make money. If you can buy businesses that beat expectations consistently, and there are CEOs out there that we know that deliberately put out a forecast that they're expecting to beat. They under promise and over deliver it. And you really want to find those businesses.
Right. All right. I'll throw you 4 stocks. Just pick one, and then we'll wrap up on this.
Okay.
WTC, TNE, RMD, or VLS.
Resmed.
All right.
This is another really high quality business that we think, like Cochlear, is really just touching the surface of its total addressable market. Good return on equity, and it's creating an ecosystem where people buy masks, and then of course they have to maintain. There's replacement parts that they need to. So they buy the device, the pump, if you like. This is for those that don't know. This is a sleep apnea product. This is for people who aren't breathing when they're asleep, and so it's putting oxygen. It's forcing oxygen into their lungs. So they need to buy a device to actually do that and then replace the masks. So you've got this recurring income stream that's being generated from each customer. It's supported by Medicare and Medicaid. And also, I should add that they're continually enhancing and upgrading the machinery. And so people will then upgrade to the newer machine, the better machine, as well as this recurring income that comes from replacement of the masks. So this is a business that ticks a lot of boxes in terms of future growth, in terms of new customers, but also increasing revenue from existing customers.
Great, thank you for that.
The only downside,
all right, well,
you can see the share price drop there a lot. So that September 23 share price fall. That was Ozempic. That was
the weight loss drug.
Yeah, the weight loss drug. So if a lot of people are taking weight loss drugs and losing weight, then they're not going to suffer as much from sleep apnea, and so people won't need this product. And there was a really significant decline in the share price. You can see it went from about $34 down to almost $20. It was a substantial decline in the share price. And it happened because people thought, right, that's it, this company's over. They're not going to sell that many masks. What people didn't realize is that Ozempic costs between $1,000 and $3,000 a month in terms of maintaining the subscription to the drug, and you've got to keep taking it. If you don't keep taking it, then the weight goes back on. And the other problem is there's not a huge number of people that can afford to pay those kinds of fees for their medication. And unfortunately, weight tends to be there's a socioeconomic element to that.
Yep. Okay. All right. Well, thank you very much, Roger. I just want to extend a very great thank you to you for coming along to this webinar and presenting to all of our listeners. I'm sure everyone's really enjoyed it. Thank you for taking the time. And thank you, everybody who's tuned in. Thanks for taking the time to listen to us today. I do apologize that the questions have been coming thick and fast. We've tried to get to a selection of them, but if we missed your question, I do apologize that we didn't have time to get to it. As mentioned, we will have more webinars coming up in this series, so please do take the opportunity to tune into those. But that's all we have time for today. So thank you very much for your attendance, and we look forward to seeing you at our next webinar. Thank you.
Thanks, everyone.